Hello friends, we will continue our discussion on the chapter of admission of a partner. Now let's see what we have studied so far. First of all, we studied about new profit sharing ratio. That is the ratio in which all the partner means including the new partner will share the future profits of the firm. That is new profit sharing ratio. Then we discussed about sacrificing ratio. What is sacrificing ratio? The ratio in which all partners sacrifice their share of profit. That is the sacrificing ratio. How we calculate this? Old share of the partner minus new share. This comes to sacrifice. Clear? Then we discussed about goodwill. What is goodwill? Goodwill is reputation. Why we study goodwill in admission of a partner? Because this goodwill is earned by the old partners. This reputation in the market has been established by the old partners, and the new partner on joining the firm will enjoy this reputation. So he must pay something to the old partners who have worked hard for this reputation. What is this payment called? Premium for goodwill. And we discussed about the various cases under which the premium for goodwill will be brought by the new partner. Right? Brought in cash, retained in business, brought in kind, brought in cash, withdrawn by old partners, not brought in by new partner, brought in partially by new partner. Then we discussed about hidden goodwill also. That sometimes we are not given the direct information about goodwill, but we are given the share of capital brought in by the new partner. On the basis of that, we will find out the hidden goodwill of the firm. Right? Now we are moving on to the next topic. What is the next topic? Next topic is revaluation of assets and liabilities. Right? Now, we have studied this topic in detail in the chapter of change in profit sharing ratio also. Now, why we are studying this topic in admission of a partner? Let's see that. Now, first of all, what is revaluation of assets and liabilities? What do you mean by revaluation of assets and liabilities? Right? It means we are going to identify the real value of assets and liabilities which can be different from book values. Which can be different from book values. Book value means the values which are appearing in the balance sheet of the firm. Right? We are going to identify the real value of the assets and liabilities in the market which can be different from the book values. Now the question is, when we are going to identify this value, when we are going to put this new value to our assets and liabilities? The answer is on the date of admission of a new partner. What it means? On the date of admission of a partner, we have the book values of the assets and liabilities. We have the balance sheet, right? But on the very similar date, we will identify what is the value of our assets and liabilities in real, in market. What is the value of our assets? We have to revalue our assets and liabilities on the date of admission of a partner. Why? The question is why? Right? The answer is very simple, that we do not want new partner in any sort of advantageous or loss position. Right? We do not want a new partner to be in the advantageous or in a loss position after the admission of a partner. Why? Because that may create conflicts in future. Now there is an asset, plant. Let's take an example. We have in the balance sheet plant and machinery, say 50,000. Now on the date of admission, this plant and machinery is worth 60,000, right? So this is a profit to the firm. How much profit? 10,000. But you see, on the date of admission, this value is 60,000. This value appreciated during the period when the new partner was not in the picture. So this profit of 10,000, this belongs to only old partners. Very simple logic. Before the date of admission, whatever the profit or the loss is, whatever, whether there is any kind of a profit, whether there is any kind of an appreciation, whether there is any kind of a loss, distribute among old partners in old ratio. Anything before the admission of a partner belongs to old partners, and that should be distributed among the old partners in old ratio. Write down a note here. Write down this note. Anything before date of admission of a partner belongs to whom? Belongs to old partners and should be distributed in old ratio. Clear? Anything, any profit, any loss, any appreciation before the date of admission of a partner belongs to old partners, because that appreciation, that profit has been earned before the date of joining of the new partner. This appreciation of 10,000 is during the period when the new partner was not in the picture. Therefore, this profit belongs to old partners and that will be distributed in old ratio. Right? That's why we are revaluing our assets and liabilities, so that our new partner does not gain unnecessarily. If there is any profit on the revaluation, that belongs to the old partners. because that value appreciated before the date of admission when the new partner was not in the picture. So new partner must not be getting the benefit of that. That must be distributed among the old partners in old ratio, right? You may write this down. This note is very important. Okay. Now let's see how to revalue it. If I talk of assets, right? If there is an increase in asset, apply the rule. What is the rule of journal entry? Debit what comes in and credit what goes out. What is the rule? Debit what comes in and credit what goes out. Now if there is an increase in the value of an asset, whether the asset is coming in or going out, the asset is coming in, so we will debit the asset account. We'll say asset account debit, and to revaluation account we'll open one new account, that is revaluation account. Clear? Similarly, if there is a decrease in the asset, now in this case the asset is going out, the asset will be credited and revaluation account will be debited. We'll say revaluation account debit to asset account. Clear? Very simple. The rules of journal entry you have to apply. If there is an increase in the value of asset, that will be debited. Asset is a, what is asset? We will debit the asset. Debit what comes in. Asset is coming in. Clear? So we will always debit what is coming in. Increase in the value of asset means increase in asset. Asset is coming into the business. We will debit the asset and credit the revaluation account. We will open one new account which is known as revaluation account. Now if I talk of liabilities, right? Increase in liability. What will happen if there is an increase in liability? What is a liability? We have to pay. We have to pay to someone, right? There is some amount pending that we have to pay to someone. If we have to pay to someone, something will be going out of our pocket. So that thing will be credited and what will be debited? Revaluation account debit to liability account. Right? There is an increase in the liability. There is an increase in the amount that I have to pay to someone. Right? So there is increase in money outflow. Credit what goes out. Something is going out. There is an increase in something, increase in amount that will be going out. So I will credit it and debit the revaluation account. Similarly, if there is a decrease in the liability, what will happen? Liability will be debited. Liability account debit to revaluation account. There is a decrease in the amount that I have to pay to someone. In other words, the amount is coming in. So I will debit the liability account and I will credit the revaluation account. Clear? Now the profit or loss on the revaluation. Now profit on revaluation. Simply this profit will be credited to the partners and revaluation account will be debited. Now the question is, to whom this revaluation profit belong to? To all the partners, or to the old partners, or to the new partner? This revaluation profit, the revaluation of assets and liabilities, this new values belong to the period when the new partner was not in the picture. So this revaluation profit belong to old partners. In which ratio? In old ratio. Clear? Similarly, if there is a loss on revaluation, then this loss also belongs to the old partners only. They are liable for this loss. So we'll say old partners capital account debit in old ratio to revaluation account. Clear? So these are the journal entries relating to revaluation account. One more thing, if there is any asset that is unrecorded on the date of admission of a partner, we forgot to record that asset, that will also come here. In this case, there is an increase in asset. Clearly, right? So you can prepare the revaluation account from here, right? I will prepare the revaluation account with the questions only, practical. We prepared it in the change in profit sharing ratio also. So I'll suggest that you must go through those lectures of change in profit sharing ratio for more details. Although we are doing it in detail only, but you must go through those lectures first. That will make the things more clear for you, right? So let's do one practical problem on this. See, pass the entries in the firm's journal for the following on admission of a partner. There are unrecorded investments worth rupees 5,000. There is an unrecorded liability towards suppliers for rupees 1,500 and an item of 600 included in sundry creditors is not likely to be claimed, hence should be written back. First point, unrecorded investments worth rupees 5,000. Now what are investments, asset or a liability? Very simple, you all have studied a lot about this. The investments are assets. So there are unrecorded assets worth rupees 5,000. What will be the journal entry? There are assets with us which are unrecorded, which are not been brought in the books. Now what to do that? We will bring that in the books. What will be the book say? Unrecorded asset, increase in asset. What will be the entry? Entry will be investments account debit to revaluation account. Amount is 5,000 and 5,000. This is entry number 1. There is an increase in the asset, that is investments, by 5,000. These investments were unrecorded in the books. Now we will record it in the books. Our asset side will increase by 5,000. Okay. Second, unrecorded liability towards suppliers for 1,500. We have to pay a certain supplier rupees 1,500 which we have not brought to the books. The supplier will come to us and he will ask for his rupees 1,500, but we will say we haven't shown it in the books, we can't pay. This is absolutely wrong. We have to bring this liability to the books. How to bring this liability? There is an increase in the liability, there is increase in the amount that we have to pay, that will go out. So what I will do is, I'll simply say revaluation account debit to liability account. How much is the amount? 1500 and 1500. Third point, an item of 600 included in sundry creditors is not likely to be claimed, hence should be written back. Sundry creditors are the persons to whom we have to pay some amount. The question says, out of the total sundry creditors, 600 amount we will not be paying, right? So there is a decrease in the liability, decrease in the amount that will be going out of our pocket. So I will say liability account debit to revaluation account, because there is a decrease in the liability, there is a decrease in the amount that will be going out of our pocket, right? So these are the journal entries. This is revaluation of assets and liabilities. In the next lecture, we will do some practical problems on this. In the next lecture, we will do some practical problems on revaluation only, right? That's it for this lecture. Thank you, friends.